Okay, so good day to everyone. So, this time we're going to talk about the hybrid financing. So, before we discuss the hybrid financing, um, we recall that we have already identified two types of financing. So, it could either be a liability financing or debt financing or through equity financing. So in the debt financing, so usually businesses enter into loan agreements or borrowing agreements, or perhaps they will issue bonds to the public to get the funds needed for the business. And the other way is getting money from the stockholders in the form of issuing common stocks. So however, there are financing that can neither be classified as liability or equity because of their features or qualities. So take for example mga preferred stocks. So although preferred stocks are really a part of the equity, however the features of the preferred stock is like that of a liability. Okay, because the dividends paid to the preferred stocks are fixed, and other preferred stocks are giving regular dividends. Okay, so um, and before the common stockholders can be given dividends, we have to prioritize paying first the preferred stock, especially if there are years or mga wala na bayad niya dividends in the past. So that is why although preferred stock is in form is an equity or component of the equity. However, in substance, it acts like a liability. So that's why the preferred stock belongs to the uh, hybrid financing. So when we say hybrid financing, they have the features both of the liability and equity. So other type of financing is called the leasing, or in other words or other terms, is it's the rentals. Okay, so the leasing or the rentals are commonly found in the income statement. However, the rentals, okay, so it's actually the business benefits from the usage of an asset. Okay. However, this benefit or usage is not found in the financial statements as an asset. Okay. So because the most important about the assets that we buy is the usage. Okay. So every time we purchase a building, we purchase a delivery equipment or machines. So it's actually the usage that we that the business can benefit from, and not really from the ownership of those assets. However, if we buy those assets, so instead of leasing, we can either have we can find them in the asset section, and if we are borrowing money to buy the asset, so it is also found in the liability section. We have the warrants, or um the chance for the owners to own shares in the future at a fixed price. Okay, so there's already a predetermined price set to be bought at a later date. Okay, so these are not yet stocks, but these are the rights. Okay, so rights that can be converted into shares later on. Then you have the convertibles, so you have the bonds. So there are bonds that can be converted into stocks later on, or preferred stock that can be converted into common stocks in the future. So we will only tackle these four. So as the common hybrid financing. So we have leasing, preferred stock, warrants, and convertibles. So let's discuss first leasing. So if you recall in your financial accounting, so the lease are classified into two. So operating lease and the capital lease or finance lease. Okay, so the reason for this why it is classified as operating or capital lease, it's because there are leases that somehow okay uh, maximizes the total benefit from those assets. So for example, if the life of that asset is only 4 years and then we are renting for almost 3 years, so we are actually uh, it's as if that we own the property because we are the ones benefiting from the usage throughout the life of the asset. So other businesses prefer leasing because uh, they can uh, they cannot put it as an asset. Okay? So pwede siya nga dili ibutang as asset and then there is no liability involved. Okay? So so of course kung may liability, so the debt ratio of the business will still remain. Okay? So the leasing is often referred to as the off balance sheet because the financing of the lease is not capitalized. So most of the time, the leases or the rentals are not capitalized. But remember that the important thing about the assets are the usage and not really the property itself. Okay. However, we cannot put usage of the asset as part of your asset. So therefore, it is not capitalized, and it is only found in our expenses or the income statement. So leasing is a substitute for debt financing. So instead of borrowing money and buying the asset. So some businesses opt to just enter into lease agreement or rental agreement. So sa leasing manggod walay interest. Although ang uban na ay interest, however, it's very seldom nga ang rental na ay included ang interest expense. Whereas in the debt financing, aside from the acquisition cost, you are also going to pay the interest expense. Capital leases are different from operating leases in the following manner. So first, the capital leases do not provide for the maintenance service. So when we enter into capital lease or finance lease, so the maintenance cost is not the obligation of the lessor or the owner of that property. Whereas in the operating lease, so part of the rentals nga ginabayad is included na ang or no, if there are maintenance costs, it should be shouldered by no, no, it should also be shouldered by the lessor. Second, capital leases are not cancelable. So if a finance lease or the lease is not cancelable, so there is a prima facie evidence that it can be a capital lease, especially if we are using the asset most of the time or most of its life of the asset. Third is capital leases are fully amortized. So fully amortized. So meaning the value of the property, okay? So ang katong cost niya is kung imong i-add tanan imong rentals, so somehow it already shoulders the entire acquisition cost of the property. So it's as if you are the owner of that property. So comparing a lease and borrow and buy method, okay? So asa man ta mas maka-benefit. So how to compute kung asa ang mas advantageous sa duha, sa lease ba or sa borrow and buy uh, the buying the asset. So we have the data. So the computer cost 1,200,000. So na siya kamahal. So $1,200,000. So you have the depreciation is 3 years using the MACRS. So I just forgot the full name of the MACRS, but it's actually a type of a depreciation method that is used in the US. So in the Philippines, I think I do not hear a company that is using the MACRS. And the asset has a 4-year economic life, and the tax rate is 40%. The interest rate is 10% annually. Maintenance of 25,000 per year, and they are payable at the beginning of each year. And then the residual value is 125,000. Then the 4-year lease includes already the maintenance, and the lease payment is 340,000 per year, payable at the beginning of each year. So so why is it important that we have to determine whether it's an operating lease and capital lease? Now, per the IFRS, I think IFRS 6, if I'm correct, if I in IFRS 16. So if it is an operating lease, so we can only find this as an expense, a rental expense or lease expense. However, if it is classified as a capital lease or finance lease, so mag-reflect ka sa imong journal, or you have to journalize the an asset and a liability nga section. So so let's compute. So the depreciation, as we know, is a non-cash outflow. So there is no cash outflow. However, um, when we deduct the depreciation, it gives us a tax benefit or tax savings. So kay i-deduct man nato siya sa income, sa gross income, so it will result to a lower net income. So lower net income will result into lower tax, di ba? So if there is depreciation, it can actually help us lower our tax payments. So that's why we have to compute the depreciation, so we know the tax shield or the tax benefit from this depreciation expense. So using the MACRS rate, so in year one you have 0.33%. So 1,200,000 times 0.33, so you have 396,000. For the second year, so 0.45 times 1,200,000, so you have 540,000. And for third year, so same method of computing, so you have 180,000, and in the year 4 you have 84,000. So after year 4, of course, there is already there's no book value. So in lease analysis, at what discount rate should cash flows be discounted? So in analyzing mga inani nga mga transaction, lease and borrowing, so we will only consider the after-tax expense and the after-tax rate as the relevant nga mga amounts. So since cash flows in the lease analysis are evaluated on an after-tax basis, we should use the after-tax cost of borrowing. So if the pre-tax cost of borrowing is 10%, so what would be the after-tax cost? So if you have a tax rate of 40%, therefore 60% is the after-tax cost. So you multiply na nimo sa 10%, so you will have 6% as your after-tax cost of borrowing. So we multiply 10% by the difference sa 100% minus the 40% niya tax rate. So I hope you can still remember how to compute the present value. So this is the cost of owning. So year zero or at today, so we're going to buy the asset at 1,200,000. So that's why there's a negative because this is a cash outflow. Depreciation tax savings. So we get the results by multiplying 40% from the depreciation nga atong na compute di ay na. Kani nga mga depreciation expense, multiply it by 40%, then that is their tax savings. For year one, that's 158.4. Second year is 216. Third year is 72. And year four is 33.6. As to the maintenance, so in our data, giina, it's 25,000 per year. So by the way, this is in terms of thousands, kaning mga figure dere. So kung 25,000 per year, remember that the maintenance expense can also help us decrease our tax. Okay? So we will only compute for the maintenance cost after the tax benefit. So the tax benefit, 25,000 times 60% or the after tax rate. So you have each year 15. So it also stated nga beginning of the year. So at year zero, you're already paying 15. Then at the start of the second year or at the end of year one, so 15 and so on. So compute the total inflow from each period. So today are going to have a cash outflow of negative 1,215,000. So muna ang total nga atong gibayad ron. On year one, so there is a net. So this is a cash inflow. So nisulod. That's 143.4, 201, 57, and 108.6. So since they are present value. For year zero, there's no need to compute because that's already the price today is also the present value. So 143.4, so that's multiply it by 1.06 raised to negative 1. For year 2, negative 2, negative 3, and negative 4. So it total nimo tanan present 66.948, or we can uh, round it off to 766.95. So it's a negative because it's a cost, diba? This is a cash outflow. Okay, so notes on cost of owning analysis. So depreciation is a tax deductible expense. Okay, so in the point of view of finance, however, depreciation is non-cash expense. So wala gyud ka ng virtually walay cash nga nigawa sa business when we compute for the depreciation expense. So it produces tax savings. So for year one, that's 158.4. So ang 396,000 niya depreciation, i-multiply sa 40%. So each maintenance payment of $25,000 is deductible. So the after-tax cost is 15. So 1 minus T or 1 minus 40% is 60% multiplied by 25,000. So you have 15,000 per year nga maintenance expense. Okay, because ang katong 40% that's a tax benefit or tax shield. So i-deduct na siya sa 25. The ending book value is zero, so the full 125 nga salvage value is taxed. So kung ending book value niya is zero at year 4, so the residual value at the end of its life should also be taxed because um, it's part of the cash inflow. So we're done with the computation of the cost of owning the asset. So let's compare it with the cost of leasing. So unlike in the cost of owning, so mas straightforward kay cost of leasing because there is a uniform cash flows, 'di ba? So consistently there is a uniform nga payment, cash payment. However, rental expense are also uh, can help the business in minimizing its tax payments because of course the lease or the rentals are deducted as expenses. So again, what is relevant in our analysis is only the after tax nga benefit or nga benefit lease payment of 340,000 per year. So at the beginning of the year, so the after tax cost of the lease, so multiplied my 1 minus t or 1 minus 40% or simply the 60% times 340. So your total cash inflow per year is 204. Okay, so every uh, at the start and every year afterwards, so you are going to pay 204,000. So you can use of course the present value of the since nag-start pa kag bayad at year zero or at the start, you use the formula sa katong present value of annuity due. So the present value of that is using 6% as the discount rate is negative 749.29. So so of course in terms of cost, so we will choose who has the lower amount. Okay. So comparing the cost of owning, cost of leasing, of course, the cheaper here is the cost of leasing. So the net advantage of leasing is computed by deducting the cost of owning, which is at 76 or 766.948 minus the cost of leasing, which is the 749.294. So in short, we have a total cost or net advantage of 17.654. So if it is in thousands, so 17,654 is the net advantage of leasing. So we can save 17,654 if we rent instead of buying the asset. So since the cost of owning outweighs the cost of leasing, therefore the firm should lease. So what if there's a lot of uncertainty about the computer's residual value? So going back to those data, so all of these data are certain, so we can verify its cost. So the depreciation is of course it depends on the policy of the management, but it is most certain, di ba? The tax rate dili na siya basta-basta i-change. So every year perhaps you will have the same tax rate. Discount rate, of course, if we enter into borrowing agreement, so naka-stipulate yun na sa contract. Same with the maintenance cost. However, among the data given here, ang pinakadili gid certain is or pwede nga magbago-bago is the residual value. Okay? Because as we know, market value or fair value is nakadepende na siya sa demand and supply. So, among all the data given here, it is the residual value that is probably uncertain. So what do we do with the this uncertainty? So the residual value could range from $0 to 250,000 and has an expected value of probably 125,000. So to account for the risk introduced by an uncertain residual value, perhaps you can use a higher discount rate to discount the residual value. So pwede mas taas-taas nga discount rate atong i-compute for the present value of the residual value. So even though the cost of owning would still be higher compared to leasing. So in the lease contracts or in the rental contracts, so there are possibly a time where you can rent. Okay, perhaps there's a kuan kanang sabot nga, for example, you are going to rent this property, so for 1 year na di mo i-rent. Otherwise, if you do not continue, you will pay the remaining amount. There are also lease contracts that has a cancellation clause, so meaning they can stop the leasing or they can stop the lease agreement anytime. So what will happen if there is a cancellation clause in the lease agreement? How would this affect the riskiness of the lease? So if you are a lessee or you are the one paying the rent, so the cancellation clause lowers the risk. Okay? However, if you are the lessor, so ikaw ang nagdawat sa bayad, a cancellation clause will increase the risk. So of course, ano mo taas ang risk, it's because there is a possibility nga ang imong gi-expect nga rental payments will not be achieved. Okay, so we're done with leasing. Now let's move to the preferred stock. So how does the preferred stock differ from common equity and debt? Preferred dividends are fixed. However, they may be omitted without placing the firm in default. So although the dividends are fixed, pwede na siyang dili sa bayaran, especially if kulang ang money to pay the loan. Okay? So we have to prioritize the outside creditors um, kaysa sa mga stockholders. The preferred dividends can be cumulative, but there is a certain limit. Okay? Most preferred stocks prohibit the firm from paying common dividends when the preferred is in arrears. So we prioritize paying the preferred stock dividends kaysa sa common stocks. So especially if there are arrears in the preferred dividends, so we will pay first the arrears before we can pay the common stock dividends. So what is the adjustable rate preferred? So there are dividends that are patterned or mirrored sa rate ni treasury nga mga securities. So it could be treasury bill, treasury notes, or treasury bonds. So these are mirrored kung whatever is the rate being offered by the government on those securities. So they will follow those rates. So let's say kung 5% ang naa sa treasury bond karon, so ang ila pong i-offer nga dividends or ilang ihatag nga dividends is 5%. If in the next year na mo siyang 4% na lang, then the dividends given the next year would only be 4%. So excellent short-term corporate investment. So only 30% of dividends are taxable to corporations. So in the Philippines, so we are using 30% tax rate. So the dividend payments are taxed at 30%. The adjustable rate generally keeps trading the near par value. However, if the issuer is risky, the adjustable rate preferred stock may have too much price instability for the liquid asset portfolios of many corporate investors. So let's move to warrants. So how can a knowledge of call options help one understand warrants and convertibles? So if you recall the options, okay, so especially call options, so it is the right to buy something or buy shares in the future. Okay, so there is also a predetermined or fixed price kung pila imong bayaran in the future. Let's say if in your agreement now you're going to buy those shares at 15. Okay? After 5 years, so although ang market na anay tag 20 na siya or 25 na siya ang per share niya, because you have entered into a call option, therefore you will only pay those or buy those shares only at $15 per share. So why is it important to understand or to know the call options to understand warrants and convertibles? Because a warrant is a long-term call option. So in the normal options contract, so there is a limited time where you can buy the shares, okay? Or kung kanus lang tama ng imong right. Otherwise, kung moabot na anang a time, let's say after 10 days, expired na imong right to buy. In warrant, that it's a long term, so it can take several years before you can exercise your warrants. A convertible bond. So a convertible bond are bond contracts with options nga pwede nimo siya i-convert into common shares or perhaps a preferred stock that can be converted into common shares. So we call them convertibles. So the convertible bond consists of a fixed rate bond plus a call option. So understanding of options will help financial managers make decisions regarding the warrant and convertible issues. So those things nga like for example how to value the options, okay? So it can still be used in the warrants and convertibles. So example, so a firm wants to issue a bond with warrants package at a face value of $1,000. So it's package na siya, meaning there's the bond has a share warrants. So the current stock price is $10 and the discount rate of equivalent 20-year annual payment bonds without warrants is 12%. So if walay warrants, so you can the discount rate or the interest rate nga imong ihatag sa mga bondholders is 12%. So for each bond, it is attached 50 warrants. So kada bond nga paliton which is worth 1,000, so na siya 50 warrants or rights to buy shares in the future and has an exercise price of $12.50. Each warrant or the right to buy is 1.50. So what coupon rates should be set for this bond plus warrants package? So first, I calculate the value of the bonds in the package. So the value of the package, so atong pagpalit atong package is worth $1,000, pero kaning 1,000, it's composed of the bonds, the value of the bonds plus the value of the warrants. So we can compute the value of the warrants by multiplying 50 sa price kada warrant, which is $1.50. So the total value of the warrants is $75. So how to get the value of the bond? So simply deduct 1,000 sa $75. So 1,000 minus 75 of $925. Next is to calculate the required annual coupon rate for bond with warrants package. So if you use the financial calculator, So if the coupon rate is 11%, so the output, the coupon payment is 110,000. So each year, the company will pay 110,000 for the bondholders. And the rate or the coupon rate is 11%. So giyon sa pagkuha ang 11%, so that's 110 divided by 1,000. What is the expected rate of return to holders of bonds with warrants? So if you exercise the price, or if we exercise the warrants in 5 years, so let's say the price of the stocks at that time is 17.50 each stock. So remember that part in our contract. So in the future, we can buy shares at 12.50. Okay. So if the stock market or the market price is now 17.50, and then the exercise price is 12.50. So the business or the entity will have an opportunity cost of $5. So so divide naka-fix naman imong price nga giset, pero in the market pwede gid siya actually ibaligya at 17.50. But since we have the investors have warrants, so kung unsay nakabutang na exercisers din ang kaya ilang gamiton to buy the shares. So if the bond has 50 warrants, and then the opportunity cost of each warrant is $5, then you have a total opportunity cost of $250. So finding the opportunity cost of capital for the bond with warrants package. So as we know, each year for the 20-year nga life sa bond, you're going to pay 110. Okay, although today you will receive 1,000, but the year after that, until 20 years, you are going to pay 110. And then pag abot na sa 20-year, aside from the interest niyo imong bayaran sa bondholders, imong i-return ang ilang capital. Okay, so that's one negative 1,000. However, for those exercising the warrants on year 5, so 'di ba the total opportunity cost is 250,000. So i-include na siya sa computation of the total present value. So that's why on year 5 you have a total cash outflow of 360. So include to get the IRR or internal rate of return using the financial calculator or the spreadsheet. So the IRR is 12.93. Okay? So this is actually equivalent to the effective interest rate. So ang tinuod yun niya, cost of issuing bonds with warrants package is at 12.93. So the firm is now considering a callable convertible bond issue. So after discussing the lease, the preferred stock, and warrants, so let's talk about the convertibles. So again, we can issue two types of convertibles. So pwede ang bonds i-convert into common stocks, or perhaps the preferred stock can be converted into common stocks. So in a 20-year, 10% annual coupon, callable convertible bond will sell at its 1,000 par value. Straight debt issue would require a 12% coupon. So conversion value, so if the price of each The price of each bond is $10. The dividend is 0.74, and then the growth rate is 8%. So how to compute and then the conversion rate is, ratio is 80 shares. So how to get the conversion price? So if the 1,000 bonds can be converted into 80 shares, so therefore, the conversion price is equivalent to 12.50 uh, per share. So the conversion price is usually set at 10% to 30% above the stock price on the issue date. So what is the convertible's straight debt value? So if you recall, so kung wala day warrants, the coupon rate is 12%. So kung wala siya warrants, the value of those bonds would only be at 850.61. So because the convertibles will sell for 1,000, so so if the value of the bonds without warrants is 850.61, so since the package is sold at 1,000, so therefore what is allocated to the conversion or to the convertibility value is 149.39. So gikuha siya pag by deducting the value of those bonds sa 1,000. So because that can be converted into 80 shares, so the convertibility value per share is at 1.87. So the convertibility value corresponds to the warrant value in the previous example. What is the formula for the bond's expected conversion value in any year? So how to get the conversion value? So C sub time. So whatever is the time, so 0, 1, so on. Conversion ratio multiplied by the price and then multiplied by 1 plus the growth rate raised to time. Okay? So for example, today, what would be the conversion value? So at time 0 or today, the conversion value is 80 multiplied by 10 per share and then 1.08 raised to 0, which this is actually equivalent to 1. So the total conversion value at today is $800. If we compute for the conversion value on year 10, so 80 times 10 per share multiplied by 1.08 raised to 10, so you have a total conversion value of $1,727.14. So what is meant by the floor value of a convertible? So the floor value is the higher of the straight debt value and the conversion value. So floor value is kung asa daw ang higher sa katong bonds or debt nga walay warrants or it cannot be converted, and the conversion value. So at time zero, so kung asa ang higher ani, kung ang straight debt value is 850.61, then sa atong na-compute gain nga conversion is 800. So since higher man ang straight debt value, so therefore the floor value of those convertible today at time zero is 850.61. At year 10, so compare the two values, the straight debt value 887, the conversion value at year 10 as atong na-compute gain is 1727. So kay higher man ang conversion value, therefore the floor value of the convertible is 1,727.14. Convertibles usually sell above floor value because convertibility has an additional value. So although we set the floor value, but convertibles daw kuno are usually sold at above those floor value because the investors see the conversion as an additional value. When is the issue expected to be called or paliton? The firm intends to force conversion when its conversion is $1,200. So kung maabot og $1,200, the company may opt to buy the shares. We are solving for the period of time until the conversion value equals the call price. So after this time, the conversion value is expected to exceed the call price. So we're expecting that mga year 5, okay, or year 5 and beyond. So the call price would equal to the conversion price. What is the convertible's expected cost of capital if converted in year 5? So if it is called at 1,200, siya. So just i-input all the cash inflows in the spreadsheet or in the downloaded financial calculator so you can get the IR nga 13.08%. Is the cost of the convertible consistent with the risk of the issue? So to be consistent, we require that the discount rate, the conversion rate, and the equity rate is the same. I don't know. The discount rate is lower compared to the cost conversion rate, and the conversion rate is lower sa cost of equity. The convertible bonds risk is a blend of the risk of debt and equity. So the RC should be between the cost of debt and equity. So kaya naman siya sa tunga-tunga between the liability and equity. So the conversion risk should be the conversion rate should be higher than the discount rate of the liability but lower than the cost of equity. So RS for the stock rate, so 0.74. So you have 16%. So since the conversion rate is lower, which is at 13%, the discount rate is 10%. So therefore, it is consistent. So besides cost, what other factors should be considered when using those hybrid securities? So first you have the firm's future needs for capital. So if there is a future need for capital, then the exercise of warrants brings in new equity capital without the need for to retire the debt. Conversion brings in new funds and low coupon debt is gone when bonds are converted. So if the bonds are converted into stocks, so mogamay ang liability pero musaka ang equity. So pag gamay ang liability, pwede na pod mag issue og new debt. So other issues regarding the use of the hybrid securities. So does the firm want to commit to 20 years of debt? So if not, the conversion can actually be a tool to remove the debt while the exercise of warrants does not. So sa conversion, pwede mawala ang liability, pero sa warrants, dili. If the stock price does not rise over time, then neither warrants nor convertibles would be exercised. So of course, attractive ra ang katong warrants and convertibles if the stock price is higher compared sa naa sa exercise price. So let's say ang naa sa exercise sa warrants and convertibles is 12.50, dapat higher than 12.50 para mas ganahan mo exercise ang mga investors. Otherwise, those warrants and convertibles would not be exercised and the debt would still remain outstanding. Okay, so that's all for the hybrid financing. So we discussed the features of the preferred stock, the leasing, warrants, and convertibles, and also how to value and to make decisions, especially sa leasing apart. So comparing the computation for the leasing and the cost to buy an asset. Okay, so if you have questions and clarification, please feel free to email and message me. So thank you for your time. Thank you for listening and God bless.